Hi everyone, welcome back to my channel. So today's video is all about option trading rules that can help prevent losses. But I do want to start off by saying that no rule can completely eliminate losses. So the goal here is just to structure trades so that losses are predefined, rare, and small, while winners, of course, are protected and scaled. So in this video, I'll explain a set of rules that are generally best practice, the key elements that you can track, and how you can get an edge as a day trader. And then lastly, I'll provide an exact trade structure framework you can test and backtest. But keep in mind, new traders get the most traction from the discipline and repeatability of these types of rules just because you're brand new to it, so you're able to adapt your trading strategy and your plan based upon preset determined factors that you otherwise may not have been aware of. Not saying experienced traders can't benefit from these rules, but typically they already have a set plan in place. So let's just go ahead and jump right into it. As y'all can see, I have NVDA pulled up here on the chart. So I want to start by going over some core rules, and these are basically going to be the foundation of preventing losses. First things first, before you do anything, you always want to make sure you define your risk before you trade. Every single order must follow this rule. So in order to do that, always make sure you're taking a look at the trade tab. And for whatever contract that you're actually considering, calculate the exact dollar amount you'll lose if your stop is hit. If you don't know this number before entry, you don't have a trade. Now, in order to make sure that you're utilizing this calculation properly, of course, you're taking a look at the bid and ask price to start. You, of course, want to analyze the option Greeks as well, and I'll touch on the open interest and volume in just a sec. However, the main priority is making sure that you know exactly what the defined risk will be before you enter the trade. So typically, day traders risk a certain percentage or dollar value per trade. And it's typical to have that number at 10 to 15% because this is pretty moderate, whereas 20 to 25% is average of your account value per trade. Now you definitely want to make sure that you convert that to contracts using the trade's max loss, and that's essentially going to be the premium that you pay for buys and the max spread loss for verticals. And the main benefit in this is that it keeps any single loss contained. Me personally, y'all know how I am. I prefer defined risk structures for most trades because a defined risk is basically like a preset worst case scenario, which can minimize emotional attachment to trades. Another thing to always consider is that you want to make sure that you match the expiration to the expected time horizon. So when you're looking at the weeklies, always make sure you're taking into account the trades with high liquidity. So if you're looking at swing trades, generally 30 to 90 days out of DTE, these types of contracts usually come with a smaller theta. So with that in mind, it kind of goes without saying, if you're looking at something with short-term DTE, you may want to avoid buying weekly options for trades you expect to hold for a week. Reason being is that the theta is likely going to be too high in comparison to the delta. Now, in respect to the implied volatility context, always make sure you're taking a look and using the IV rank appropriately. So whether you're buying or selling premiums, make sure that it makes sense for when the rank is elevated versus when it's minimal. And kind of staying along in the same realm of that, you want to make sure you use position sizing by volatility. And this can be indicative of any strike price that you select. When the implied volatility is high, you can reduce the contract count, and when spreads are wide, you can reduce even further if necessary. Now the size must reflect the execution risk, not just the account percentage. So a best recommendation is to only trade liquid strikes and expirations. And at the minimum, you want to narrow down your bid-ask spreads and make sure that they're relative to the premium itself. Because it's always best to take into account the daily options volume and open interest. You always want to make sure these are solid, because illiquid fills will turn winners into losers so fast. So set mechanical exits, and this is basically a stop plus a target before you enter, and then definitively define them. So if you select your contract, always be sure to use a hard stop. And this can be based upon a price or a percentage and at least one profit scale out rule. So if you get stopped, accept it and just simply move on. And when you're analyzing your trade, if your live stats diverge from backtest, pause and then retrain yourself on what you need as far as correction. Now, some of the main key elements to monitor, these are going to be the clues that protect your capital. One main factor always being implied volatility, because this tells you if you're paying a premium or collecting a fair price. And then in reference to bid-ask spreads, as mentioned, you want to make sure the execution reality is always evident. So plan for spread costs accordingly. And I'll also go deeper into open interest and volume, but the main takeaway from that is just that liquidity confirmation for the strike that you plan to trade, it must align. And then if we're specifically looking at delta and gamma, how the option behaves versus how the stock or ETF moves and how quickly the delta will change, this can also be a determining factor in profitability, because it's always best to manage your gamma risk on short-dated trades, with a little bit more consideration on those that are long-dated. Now, of course, theta is going to be the time decay, and this is crucial to consider for swing trades and for sizing positions on short DTE buys. Now, with that in mind, the underlying price structure is something to also consider. So let's say, for example, you're analyzing the charts and you're looking at the stock's behavior over the course of time. You may pinpoint specific support and resistance levels, and you want to make sure that this correlates with the VWAP strategy, because you can trade with price context, not necessarily just in isolation. And then also, it may be minor to some people, but I think it's super important to pay attention to the event calendars. So whether that's earnings, FMOC events, CPI information, this all will help you avoid or structure for events deliberately. So it's always best to be very intentional with the information. And then another aspect to this is the day trading specifics. So how to get ahead when you're intraday trading. One factor to consider is to only trade liquid names. So for example, y'all know I like to trade SPY, Tesla, QQQ, even NVDA, because these are high flow tickers. And for the most part, what that means is that higher liquidity dictates tighter fills and less slippage. So for example, if you're deciding to trade near-term contracts with sharp deltas, for buys, you can choose a delta with a 0.5 or better. And this just simply allows you to see that the contract will actually behave more like the underlying stock or ETF would. And for instance, here on the screen, we can see that every single one of these in-the-money contracts for 3 days of DTE on the call side have at least a 0.5 or better for the delta. Now the theta, on the other hand, that's a total different story. So always comparatively keep these two in mind. Now for scalp trades in particular, you want to make sure you're using higher delta to reduce time decay sensitivity. And for new day traders, you may have to keep your trades small, repeatable, and set for a specific price trigger. So it is recommended to use limit orders for entries and OCO brackets for exits. But if you're one for fast execution, feel free to use market orders. And then this is super advantageous because you can plan bracketed exits so that heat of the moment don't fade your decision making. And that goes hand in hand with making sure that you're monitoring the implied volatility intraday, because IV can spike pre-news or post-news and crush prices completely. So always avoid buying premiums right after big IV runs unless you have an intraday catalyst supporting it. And the reason that's so important is because time windows matter. Typically when you're day trading, you'll see that the first 60 to 90 minutes of the market's open, and from time to time the last hour of the day, are when you'll often see the most activity in the market. Now that's not always the case, but for the most part that's generally true. So be on high alert to trade where participation is high. Now with that, you'll often see that midday consolidations often produce false breakouts. And along those lines, always cut your losses fast and scale up on winners. But if you need to take partial profits early and move stops to break even on the remainder, no harm, no foul in doing so. Alright, so the next thing to consider is how to formulate a repeatable trade structure. So most of this information will be universal concepts that work across the board, and the first being setting conditions. As mentioned, you want to make sure you develop an actual watch list. I would recommend having anywhere from 8 to 12 tickers that you trade pretty often, and basically this just will start you off by choosing a handful of stocks and ETFs that move. So if you're brand new to trading, keep in mind that penny stocks won't get the job done. Theoretically, they may be attractive because they are cheap and inexpensive, however they won't benefit you in the long run because there's not enough liquidity within those tickers. So make sure you have a pre-filter for average daily dollar volume and recent volatility. A major thing to also consider is the example for your entry rules. Remember that momentum is key to day trading. So let's say, for example, you're looking at a break above the 5-minute VWAP with 2 times the average volume. You can enter at the money calls with delta acceleration if you notice this happening. Always make sure that you wait for confirmation by simply analyzing the charts. And then when you consider your exit for the trade, the primary profit rule is to scale. Take profit at 50% if you need to, then at 30%, and then just trail the rest with an ATR-based stop. And you can certainly switch between making sure it's a trailing stop or a hard stop, depending on what you're more comfortable with. Now, if the option's value falls by a certain percentage on a day trade, or you notice that price is crossing under a support level, you might want to reconsider how long you stay in the trade, even if it's a swing trade. Because honestly, risk controls and contingencies can make or break the entire setup. So what's good to keep in mind on this is that you should predefine when to roll. If a trade is still valid and the move is partial, rolling must pass a break even and a margin check so that you don't have as many worries about the trade. And then once you have all this down packed, you can make sure that you review the metrics. You can look at your average hold time, factor in slippage, and even IV changes. And if for any reason the performance drops, just isolate the one variable that you think is the problem. So it can be like the time of day, the ticker, for example. It can also be like open interest and volume. Any of that could potentially be something you have to adjust. And then just run another test on it. Now, as I mentioned earlier, I do want to go ahead and discuss the DTE in a little more detail, just to provide some context. So just remember, on some contracts, short DTE buys can come with high gamma and quick gains, which is possible, but never lose sight of the fact that time decay accelerates. Rewards can be large, but the time window is short, so always make sure you manage these types of trades with caution. Now, on longer DTE, the theta of course is lower, and you also have more time for the trade to play out in your favor, hence opening up the door for better swing trades and less stress over intraday noise. Now, when considering adjustments and position management, this is how you stop small losses becoming big ones. Because if the trade goes against you fast, of course you want to exit to preserve your capital, unless there's a reason that your logic remains valid, and you have a planned strategy to trade through the pullback. But for the most part, you always want to avoid averaging into losses without any real evidence. And this just helps to set up a good example of a worst case scenario, because if the trade moves in your favor, you can simply move your stop after a predetermined threshold to secure your gains. Now, most times we may ignore it, but it is a psychological and procedural way to do this, and this also helps prevent the losses from stacking up. So one thing I always recommend for any new trader is to never ever revenge trade. So if you lose twice in a row, automatically pause, because that's 2 consecutive losses. You got to figure out what's going on and evaluate the problem. So in order to do that, develop a pre-trade checklist. And if any item fails on this list, don't ignore it, because it may be enough to skip the trade altogether. And then also, y'all, keep in mind, you do not have to trade every day. If you choose to and it works, that's cool, but don't feel pressured to do so. Trade only when price action has you alert and focused to view the best possible setups. And the reason why all this matters, especially for beginners, is that you want to have clarity over noise. A dedicated approach eliminates uncertainty and reduces emotional overtrading. And without mention, of course, it's also capital preservation, because you have a fixed risk percentage and defined risk structures, which keeps accounts from taking major L's. And then over time, as you become more experienced, you can set your own rules. And this will help you create consistent data to analyze these rules, and you'll learn what works and what fails quickly. Now, for me, what matters most is the non-negotiables. So the primary takeaway is just to know your max loss pre-trade. If you don't know it, don't trade it. Also, set your targets to trade high momentum strikes and expirations, because quality matters more than marginal theoretical edge. Then you always want to make sure that you match your DTE to what you actually see on the charts, because time is as important as direction, always. And then the final bit of a practical takeaway from this is just to build a set of templates, one for intraday momentum buys to start, and one for swing defined risk trades. You can also have one for selling premiums, but that's a little more advanced. And then when you feel like this has been tested over time to play in your favor, apply them consistently. Because another thing, y'all, is you don't have to switch up your setups. You can trade the same ones over and over and still be profitable. But just make sure that you measure the real fees of trading. So that includes the spread plus slippage plus commission. Many traders fail not from bad ideas, but from bad fills. And above all, treat options like a business. Plan, test, execute, measure, and reset the plan based upon objective results. And once you have this down, all these rules will help keep your capital intact. So yeah, y'all, that's pretty much all that I wanted to discuss. And with that, that'll just about do it for this video. Y'all already know if you found any of this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.